All right, today we're diving into something really interesting, a financial model called the Vector Capital Paradigm. Now, this isn't just theory. It's a real-world roadmap designed to tackle one of the biggest killers of young companies. It's all about helping startups not just get by, but actually come out swinging. So let's break it down.
So, where do most startups die? I mean, if you're a founder, an investor, or even just interested in this space, you know this question is the elephant in the room. And you also know the answer usually isn't a bad idea or a lack of passion. Nope. It's almost always about timing and money. Specifically, a really tough, really dangerous window early.
And that window has a name, the Valley of Death. It sounds dramatic, right? But it's real. It's that awful, nerve-wracking period where you've started the company, you're spending money, but you haven't started making any real revenue yet. The cash is just flying out the door, nothing's coming in, and getting a traditional loan or investment, forget about it. This is where so many amazing companies just fizzle out. They run out of gas.
But what if you didn't have to wander through that valley blind? What if there was a map, a structured, disciplined path to get you across? That's exactly what we're looking at today. The whole idea here is to create a way to emerge from that valley, not just alive, but stronger, with a proven model and totally ready to scale. And that is the promise of the Vector Capital Paradigm.
Okay, so here's our roadmap for this explainer. We'll start with the I'm In foundation. Then we'll talk about crossing the venture debt bridge. After that, it gets intense with the Day 90 crucible. Then we'll see the equity transformation, and finally, the launch platform. All right, section 1. The I'm In foundation. So how does this whole thing kick off? Well, it all starts with homework, a lot of homework. The core principle here is to make a company completely deal ready before a single big check is written. Think of it like building the launch pad before you build the rocket. It's not just about having a cool idea, it's about proving on paper that you have a solid, investable business.
And this foundation gets built in 3 key steps. First, there's a core program to make sure the right talent is in place. Next, the company goes into what's called a funding lab. This is where the real deep dive happens. Intense due diligence, structuring, getting all the ducks in a row. And the goal of all this? To graduate as a deal-ready company with a validated data room. Now, that data room is everything. It's the company's entire playbook, the numbers, the plan, the team, all checked, double-checked, and ready to go. It's the proof that gives investors the confidence to take the next step.
Okay, so once that foundation is set and the company is validated, that's when the real clock starts ticking. We're now moving into section 2, a super intense 90-day sprint. And the fuel for this sprint? It's not a typical equity investment. It's a very specific type of loan, a venture debt bridge that's literally designed to get the company across that scary valley of death. So what does that bridge look like? It's a senior secured note, and in this model, it's issued by a partner bank like Sigma Bank. Now, those words senior secured are super important. Secured means it's backed by the company's assets. And senior means if things go south, this lender gets paid back first. It's all about managing the risk for the people putting up the cash.
And what's the cost of this capital? Well, it comes with a 15% interest rate. I know, that might sound pretty steep. But you have to remember what this is. This is cash for a company at its most vulnerable, riskiest stage. A point where, honestly, most startups can't get any funding at any price. But here's the really clever part of the deal. For those crucial 90 days, the loan is interest only. Think about what that means. The startup doesn't have to worry about paying back the big chunk of the loan, the principal. All their cash, every single dollar, can be poured directly into hitting their targets. We're talking hiring key people, launching a marketing campaign, finishing the product, pure execution.
So yeah, it really is a lifeline. But it's a lifeline with some serious strings attached. It's all about funding that execution phase, but under super strict monitoring. The company has exactly 90 days of runway to prove that its business model actually works. And you better believe they're tracking every single KPI along the way. The pressure is absolutely on.
And that pressure leads us to section 3, the Day 90 crucible. This is it. This is the moment of truth. After that 90-day sprint, everything comes to a head. It is a single make-or-break decision point that determines, well, everything.
And the outcome is incredibly black and white. There are 2 doors and only 2. Door number 1, you miss your KPIs. If that happens, the company underperformed, the lender calls in their senior lien, and they recover their assets. It's harsh, for sure, but it's a clear, quick end. But door number 2, you
hit your KPIs. You prove the model works. If that happens, a trigger gets pulled and it activates something called the equity conversion program, which changes the entire game.
And this leads us straight into the reward phase, Section 4, the equity transformation. This is where all that hard work pays off, big time. For the companies that make it through the crucible, the whole financial structure of the company is about to get a major, and I mean major, upgrade. So remember that big loan, that senior secured note? The startup doesn't have to pay it back with cash. Instead, poof, it converts into preferred equity. The debt is just gone, wiped off the books. The company is now totally free from that bridge loan. And the deal gets even sweeter. That conversion from debt to equity, it happens at a 20% discount. So the investor who took that early risk gets a nice reward, buying in at a lower price. And this is brilliant because it perfectly aligns everyone to focus on the long-term success of the company. But just getting rid of the debt and getting new equity partners? Well, that's not even the best part. Hitting those KPIs unlocks something else. Something much, much bigger.
It's called the kicker, and it is a game changer. Here's what happens. The partner bank comes in and injects a matching amount of fresh capital into the business. And listen to this. It's not another loan. This is pure non-debt capital. It's like rocket fuel for a company that has just proven its engine works.
So think about where we are now. The model is validated, the debt is gone, and there's a fresh pile of cash in the bank. All of this leads to our final section. Section 5, the launch platform. The whole point of this entire process is to turn a scrappy, high-risk startup into something the financial world calls a bankable entity. Basically, a company that's ready for the big leagues.
And being bankable opens up a whole new world. Your balance sheet looks amazing. You can get a joint operating agreement, which means you get hands-on strategic help. Suddenly, traditional banks, the ones who wouldn't have given you the time of day before, are interested in giving you lines of credit. You might even qualify for government grants. And that next big funding round, that Series A, the path to getting it just became so much clearer and, crucially, so much less risky for everyone involved.
So when you put it all together, that's what this paradigm is all about. It's a system designed to take a company that's all high-risk potential, run it through an incredibly tough real-world test, and, if it passes, turn it into a de-risked, bankable asset that's truly ready to grow. Which really leaves us with one big question to chew on, right? We know that so many startups die in that early funding gap. So could a highly structured, super disciplined model like this be the future? Is this how we get smarter about de-risking early-stage investments? It's definitely something to think about. Thanks for watching.